Dear friends, welcome to Anhad channel, where we simplify complex concepts in accounting, finance, banking, economics, insurance, and FinTech. In today's video, we will discuss an important topic in accounting: generally accepted accounting principles, Indian accounting standards, and international financial reporting standards, also called IFRS. Various professional accounting bodies began developing accounting principles and standards around the globe. India also moved towards convergence with international financial reporting standards, and as a result, Indian accounting standards were developed by ICAI and notified by the Ministry of Corporate Affairs under the Companies Act, 2013. Let us discuss them in detail. Our first topic is about generally accepted accounting principles. Generally accepted accounting principles refers to the principles, conventions, and procedures that organizations use while preparing their financial statements. These principles ensure that financial reports are reliable, consistent, comparable, and transparent. Generally accepted accounting principles helps businesses present financial information in a standard format so that users can easily understand and compare financial statements. Some of the important objectives of generally accepted accounting principles are: first, uniformity. It ensures that accounting practices remain consistent across organizations. Second, comparability. It allows investors and stakeholders to compare the performance of different companies. Third, reliability. It ensures that financial information is accurate and trustworthy. Fourth, transparency. It promotes clear and complete disclosure of financial information. Fifth, better decision-making. It helps investors, creditors, management, and government agencies make informed decisions. Let us discuss important principles of generally accepted accounting principles. These are 8 in number. 1. Business entity principle. The business entity principle states that a business is treated as a separate entity from its owner. The personal transactions of the owner should not be mixed with business transactions. This helps in determining the true financial position and performance of the business. Example: if the owner withdraws 20,000 rupees from the business for personal use, it is recorded as drawings and not as a business expense. 2. Going concern principle. The going concern principle assumes that a business will continue operating for the foreseeable future and is not expected to close down soon. Therefore, assets are recorded based on their continued use rather than their liquidation value. Example: a machine purchased for 5 lakhs rupees is depreciated over its useful life instead of being valued at its immediate resale price. 3. Cost principle. According to the cost principle, assets are recorded in the books at their original purchase cost, regardless of changes in their market value. This ensures objectivity and reliability in accounting records. Example: land purchased for 10 lakh rupees will continue to be shown at 10 lakh rupees in the accounts even if its market value increases to 15 lakh rupees. 4. Revenue recognition principle. The revenue recognition principle states that revenue should be recognized when it is earned, not necessarily when cash is received. This provides a more accurate picture of business performance. Example: goods worth 50,000 rupees are sold on credit in March. The revenue is recorded in March even if payment is received in April. 5. Matching principle. The matching principle requires that expenses should be recorded in the same accounting period as the revenues they help generate. This ensures accurate measurement of profit or loss. Example: sales commission paid for products sold in March should be recorded as an expense in March, even if the payment is made later. 6. Consistency principle. The consistency principle states that the same accounting methods and policies should be followed from one accounting period to another. This helps users compare financial statements over time. Example: if a company uses the straight-line method of depreciation this year, it should continue using the same method in future years unless there is a valid reason for change. 7. Full disclosure principle. The full disclosure principle requires businesses to disclose all material information that may influence the decisions of users of financial statements. Transparency is the key objective of this principle. Example: if a company is involved in a major lawsuit, Details of the case should be disclosed in the notes to the financial statements. 8. Prudence principle, also called conservatism principle. The prudence principle states that anticipated losses should be recognized immediately, while anticipated gains should not be recorded until they are actually realized. This prevents overstatement of profits and assets. Example: if a customer is unlikely to pay a debt of 10,000 rupees, a provision for doubtful debts should be created. However, expected future profits should not be recorded in advance. These principles form the foundation of modern accounting practices. Let us now discuss what are accounting standards. Accounting standards are formal guidelines that prescribe how accounting transactions should be recognized, measured, presented, and disclosed in financial statements. They help ensure that financial statements prepared by different organizations are consistent and comparable. Without accounting standards, companies might use different accounting methods, making comparisons difficult. We have accounting standards in India too. These are called Indian AS. They are formulated by the Institute of Chartered Accountants of India or ICAI and notified by the Ministry of Corporate Affairs. Indian AS are largely based on international financial reporting standards, with certain modifications to suit the Indian business and legal environment. Objectives of Indian AS. The key objectives of Indian AS are: improving the quality of financial reporting, increasing transparency, enhancing comparability of financial statements, attracting foreign investment, aligning Indian accounting practices with global standards. Some important features of Indian AS are: principle-based approach, fair value measurement for many assets and liabilities, enhanced disclosure requirements, greater transparency, convergence with IFRS. Today, many listed and large companies in India are required to prepare their financial statements according to Indian AS. Now we come to IFRS. IFRS stands for International Financial Reporting Standards. These standards are developed by the International Accounting Standards Board. IFRS provides a common global framework for preparing financial statements. The objective is to ensure that financial information is understandable, transparent, and comparable across different countries. More than 140 countries either require or permit the use of IFRS. The major objectives of IFRS are: creating a common global accounting language, improving transparency, enhancing comparability across countries, facilitating international investments, increasing confidence among investors and stakeholders. The benefits of IFRS include: easier comparison of companies worldwide, increased investor confidence, improved access to global capital markets, better transparency and accountability, reduced reporting differences across countries. Let us now understand the difference between Indian AS and IFRS. While both are very similar, Indian AS is not exactly the same as IFRS. Indian AS is based on IFRS but includes certain modifications to accommodate Indian laws, regulations, and business practices. IFRS is designed for global use, whereas Indian AS is specifically applicable in India. Therefore, Indian AS is often described as IFRS converged standards rather than fully adopted IFRS standards. To summarize, generally accepted accounting principles provides the basic principles and framework for accounting. Accounting standards ensure consistency and uniformity in financial reporting. Indian AS are India's accounting standards aligned with international practices. IFRS is the globally accepted framework for financial reporting. Together, these standards help improve transparency, comparability, reliability, and investor confidence in financial statements. Understanding these concepts is essential for every student of accounting, commerce, finance, and business. Friends, with this, we come to the end of today's session about accounting principles and guidelines. Thank you very much for watching this video. If you found this video useful, please like, share, and subscribe to our channel. On this channel, we regularly upload educational content on economics, finance, banking, insurance, financial crime, GST, income tax, FinTech, accounting, financial management, and investment management in a simple and easy-to-understand manner. Please explore the channel for more already prepared informative videos. If you want a video to be made on any topic, write that in the comment box. Also write for any query, feedback and suggestion. Don't forget to press the bell icon so that you receive notifications whenever we upload a new video. Thank you for your support. See you in the next video with another interesting and informative topic. Till then, bye and take care.